In general, I don't really know what we're arguing about. The rotations are still operational. It's keeping the overall market pretty well supported. We're less than 1% from an all-time high. And even though I think there's a plausible case to be made that September could be a little bit of a policy minefield with fiscal and monetary in question, and as well as, just a sort of a time for some spillback in the markets, it's not really news to the market that, hey, we hit a soft patch in growth, if that's your argument for why we ought to be going lower here.
What's your take on the markets here? I mean, given the fact that we are, less than 1% from the record highs that we hit last week for the S&P, and the fact that you could potentially in the near term see some minefields, particularly around things like fiscal and monetary policy.
So it's only a minefield. I don't know what that screaming was. It's only a minefield depending on who you're talking to. I find that the majority of the financial media is still talking to most market participants' parents. Like if you're 70 years old and you have too much equity in your portfolio relative to cash, relative to bonds, then yeah, it could be a minefield. But there are 73 million millennials now actively investing, another 75 million Gen Z coming into the market as quickly as they can, millions of new accounts a month. How do you describe a minefield to somebody who is facing the next 40 years of putting money to work? Like they are embracing these opportunities that are scaring their parents and grandparents. Like that is the way the market is set up right now. We are currently living through the second longest streak of having more than 75% of the S&P 500 above their 200-day moving average. So think about that statement. 3/4 of S&P stocks have spent the last 10 months in a statistical uptrend. So if we get a pullback because of a policy speech or whatever, think about how quickly the money comes rushing in to buy that pullback. Most of the market participants today have decades ahead of them to invest in stocks, and they're not stupid. They recognize that lower prices are better to be buying than higher prices. So this year, we've had 50 closing record highs. Nobody under the age of 50 years old should be happy about that. Why would you want to buy higher? It makes no sense. So I don't really, that terminology, the minefield idea, policy errors by the Fed, if you're relatively young, still working, still accumulating your portfolio, that's exactly what you should be rooting for, and that's what I'm rooting for. So to some people it's a minefield, and to me it's an opportunity.
But Josh, that mentality, does it mean you never take profits? That you should always just keep buying any slight pullback? Yes. Genuinely, you've never taken any profits, and you think that there's nothing that could ultimately derail the long-term.
I'm 44 years old. What am I doing with the money?
But so you're basically saying the Tina argument always holds, and relative valuation is always the thing to go for, not absolute valuation.
Okay. Yeah, no, I'm not trying to frustrate you, Wilf, but I started in this business in the late 1990s. It's been the right stance so far. And when you get to an age where you're living off of your portfolio, like you're literally drawing down your assets and taking capital out, obviously at that point the calculus changes, but your asset allocation will change to reflect that. So look, I'm doing this 11 years on CNBC telling people to remain bullish. There have been all sorts of horrific market episodes during that period of time. It's not that there's never a good time to sell. It's that unless you've got a near-term use for the money, you want to be long equities, and it's better to buy them down than up. So this idea that, we're heading into the fall and there's going to be a taper and maybe the Fed will make a mistake or somebody will give a speech someone else doesn't like. Yes, if you're over-invested and too old to replace that money in your portfolio, you absolutely need to be vigilant. But I want to remind you, the majority of market participants today in 2021 are not in that situation. They're in the opposite situation. They require drawdowns in order to get better prices for long-term investments. And I think we want to speak to everybody at the same time. We don't just want to speak with people who are spending down the rest of their portfolio over the next 5 years. That's what most of the financial media tends to speak to because it's the audience they've known for a long time. It's really important that we look at downturns in the market as being good, not just universally negative.